You know, there is a very specific, very unsettling kind of adrenaline you get when a stock that hasn't surprised anyone in 40 years suddenly wakes up and chooses absolute violence.
Violence is really the only word for it. It was a bloodbath out there.
Welcome back to Talk Tickers. We listen to the earnings call so you don't have to. It is Wednesday, February 18th, 2026. Today, we are dissecting a company that usually defines boring and steady. It's the stock your grandfather probably owned. It's the stock that is supposed to be the ballast in your portfolio. But this morning, it became the single most interesting and perhaps terrifying ticker on the board.
No question.
We are talking the Genuine Parts Company, ticker GPC.
The parent company of Napa Auto Parts and Motion Industries, a dividend aristocrat, a company that usually moves with the speed and, predictability of a glacier.
Yeah.
Today, it moved like an avalanche.
We have a massive amount of ground to cover because this was a two-story morning. It's rare you get this kind of duality in a single press release.
Very rare.
Story number one. A historic strategic announcement. GPC is breaking up. They are splitting into two independent public companies.
Right.
Usually, Wall Street throws a parade for a breakup, it unlocks value, it kills the conglomerate discount, champagne corks should be popping.
Instead, the only thing popping was stop-loss orders. It was brutal.
Exactly. The stock didn't just slide, it crashed. It was down, 7% in the pre-market?
About 7%, yeah, which is bad enough.
But by the closing bell, GPC was down 14.6%, closing around $125.74.
Wow.
For a blue chip company, a double-digit drop in a single session is a catastrophe. That is billions of dollars in market cap vaporized in 6.5 hours.
And it happened because of story number two. They tried to pair this good news of the split with an earnings report that can only be described as a kitchen sink disaster.
Like a sink, yeah.
They missed on revenue, they missed massively on earnings, and they revealed some truly ugly skeletons in the closet regarding their supply chain and their balance sheet.
So here is our mission for this deep dive. We need to solve the mystery. Why did the market reject the spin-off narrative?
Right.
Why did investors flee the scene of what should have been a value unlocking event? We're going to break this down into 4 distinct chapters. First, we're going to look at the ugly headline numbers, the actual results that scared the street. Second, we'll unpack the good news, the details of this breakup between auto and industrial.
Okay.
Third, we have to talk about the kitchen sink, the pension charges, the bankruptcies, the asbestos, all the toxic sludge they dumped into this quarter.
All the fun stuff.
And finally, stick around for the end, because we are going to pitch a trade idea in our This Is Not Financial Advice segment that we're calling the Dirty Divorce Arb.
It's an aggressive trade. It's slightly outrageous. But honestly, looking at the wreckage today, it might just be the only smart way to play this mess.
Let's start with the crime scene. The numbers. The headlines were fast and furious this morning. Revenue came in at $6.0 billion. That's up 4.1% year over year.
Right. Now, stop me if I'm crazy, but on the surface, 4% growth for a mature industrial retail conglomerate. That doesn't sound like a reason to sell the stock down 15%.
It doesn't until you look at the expectations. Context is everything here. The street was looking for $6.6 billion, so they missed the top line by about 1%.
Okay, 1%.
You're right. A 1% revenue miss is not a disaster. It's a rounding error in some books. If that was the only issue, the stock might be down, 2%?
Maybe.
But revenue is vanity, profit is sanity, and the sanity check failed miserably.
Let's look at the bottom line. Adjusted earnings per share EPS came in at $1.55.
$1.55. And the consensus estimate was around $1.82.
That is a massive whiff. We aren't talking a penny or two.
No. That is a 15% miss on profitability for a company that prides itself on predictability, on being a sleep well at night stock.
Missing your profit number by 15% is like a pilot missing the runway by a mile. It suggests management lost control of the cost structure in the quarter. It suggests that their internal forecasting is, frankly, broken.
And that 155 is the adjusted number.
Yes.
That's the number after they scrubbed it clean, added back the one-time charges, and put some lipstick on the pig.
A lot of lipstick.
If you look at the GAAP number, the generally accepted accounting principles, the real unvarnished truth, they didn't make $1.55. They reported a loss.
A staggering loss.
Wow.
A loss of $4.39 per share.
Hold on. I want to pause there and really let that sink in. A loss of $4.39 per share.
Mm-hmm.
How does a company that sells brake pads, oil filters, and industrial bearings, stable, high-margin products, lose nearly $4.50 per share in 90 days?
Right.
We aren't talking about a biotech startup lighting cash on fire. This is genuine parts company.
That is the kitchen sink we alluded to. That 439 loss is driven by hundreds of millions of dollars in one-time charges.
Okay.
We're going to unpack those in detail later, the pension termination, the supplier bankruptcy. But it essentially wipes out a year's worth of profitability in a single accounting stroke.
Wow.
But even if you are a charitable investor and you ignore those charges as one-offs, the guidance for 2026 was the final nail in the coffin.
The outlook. This is usually where management steps in and says, okay, Q4 was rough, but the future is bright.
Yeah. Here's the comeback story.
Instead, they projected sales growth of 3% to 5.5% and adjusted EPS of $7.50 to $8.
Which is weak. It's anemic. The midpoint of that guidance is below what analysts were modeling before today.
So guidance cut, basically.
It's cut. But the real kicker was the tone. I listened to the Q&A with the analysts. Management used the word prudent over and over again. They must have said it 10 times.
Prudent is usually CFO code for we're scared.
Precisely. It means we see bad things on the horizon. They are expecting Europe to stay in recession. They are expecting the U.S. consumer to stay broke. It was not an inspiring outlook for a company asking you to buy into a multi-year transformation.
Right.
They basically told investors that next year is going to be a grind.
So immediate takeaway. The company tried to bury a bad quarter under a big strategic announcement, and investors didn't take the bait.
Not at all.
They looked past the headline of, hey, we're splitting, and saw the rot in the Q4 numbers.
That's it. Now, does that mean the split itself is a bad idea? Not necessarily. In a vacuum, the strategic announcement is actually huge news.
Let's pivot to that. The good news. Genuine Parts Company intends to separate into two independent publicly traded companies. Entity number one is Global Automotive. That's essentially Napa, pure play automotive aftermarket.
And entity number two is Global Industrial. That's the brand known as Motion. This is a pure play industrial distributor. Bearings, power transmission, automation, hydraulics, all that good stuff.
The timeline here is the first red flag for me. They are targeting completion in the first quarter of 2027.
And that is problem number one. We are in February 2026.
Yeah.
Q1 2027 is a full year away. In the stock market, a year is an eternity.
It's forever.
They are asking investors to hold on to this stock through what looks like a very difficult 2026, just to get the prize in 2027.
It creates a lame duck year. The company is in limbo, employees are distracted, investors are bored. But let's play devil's advocate. Why do this? Why break up a 100-year-old empire?
It's the classic pure play argument. Right now, GPC is a conglomerate. You have a retail-facing auto parts business and a B2B industrial distribution business mashed together. They are fundamentally different animals.
Different customers, different cycles.
Completely. Auto is a retail war. It's fighting a trench war in the $200 billion market against absolute titans like O'Reilly and AutoZone. To win there, you need to focus on supply chain speed, brand marketing, retail margins, and consumer preferences. You are dealing with weather, gas prices, and used car sales trends. It's a whole different game.
And industrial.
Industrial Motion is a technical sales business. It's engineers talking to factory managers. It's high touch. When a factory line goes down, they need a specific bearing, and they need it now.
Right. Price isn't the main object.
Price matters less than availability. Motion is a higher margin, stickier business. The argument is that right now, Motion is being undervalued because it's stapled to the slower growing, messier auto business.
This is the conglomerate discount.
Yeah.
The whole is worth less than the sum of the parts.
Exactly. If you look at pure play industrial distributors like Fastenal or Grainger, they trade at significantly higher multiples, sometimes 20 or 25 times earnings.
And GPC trades it.
GPC trades at 15 times, maybe less after today. The theory is if you spin Motion off, the market will re-rate it. It will suddenly be worth that higher multiple.
So why didn't the stock pop? If the math says split equals value, why did it drop 15%?
Because of execution risk. Separating a company that has been together for a century is not like uncoupling two train cars.
No.
It's like separating conjoined twins. They share vital organs. They share IT systems. They share HR. They share tax structures. They share back office real estate. It's a mess.
Management said the dyssynergies, the costs of splitting, are manageable.
Manageable is a dangerous word. It usually means expensive, but we can afford it.
Ah, right.
When you split, you lose economies of scale. Suddenly you need 2 CEOs, 2 CFOs, 2 boards of directors, 2 headquarters. That costs money. We don't know the price tag yet, but it will be a headwind to earnings in 2027.
So the market is saying, we see the potential value in 2027, but we don't trust you to get there without tripping over your own feet in 2026.
Especially after seeing this quarter. I mean, think about it. If you can't manage a simple quarterly earnings print without a 15% miss, why should I trust you to execute the most complex corporate restructuring in your history?
It's a credibility issue.
Credibility is a currency, and they spent a lot of it this morning.
That is a brutal assessment, but it feels fair given the numbers. Let's get into the kitchen sink. I want to understand exactly how they went from an adjusted profit to a GAAP loss of $4.39 per share.
Okay, so it comes down to 3 main buckets of toxic waste they flushed out of the system. The biggest one is the pension. GPC terminated their U.S. pension plan.
Terminated. That sounds final.
Yeah.
And expensive.
It is both. Basically, GPC is taking their pension obligations, the promises they made to retirees, and likely handing them over to an insurance company to manage.
Okay.
But to get the insurance company to take that risk, GPC has to pay a massive settlement. They took a non-cash settlement charge of $742 million.
Nearly $750 million.
Right. Now, sophisticated investors might look at that and say, okay, it's non-cash, it's an accounting maneuver, it doesn't affect the cash flow today. But you have to ask why now?
Is it related to the split?
100%.
Yeah.
You cannot easily spin off a company if it has a massive, complex, underfunded legacy pension liability hanging over it.
Right. Who gets it?
Who takes the pension? The auto company.
Yeah.
The industrial company. It's a mess. It depresses the valuation of both new entities, so they decided to clean the decks.
Yeah.
They took the hit now to make the breakup easier later.
Okay, so the pension charge is actually a strategic move. Painful, but strategic. I can forgive that. It's like paying off your student loans before you get married so your spouse doesn't inherit your debt.
Good analogy.
But the next item in the kitchen sink feels a lot more worrying to me as a business operator, the First Brands bankruptcy.
This is the one that keeps me up at night if I'm holding the stock. First Brands Group is, or was, a major supplier in the automotive aftermarket. We were talking about household names like Trico wipers, Fram filters.
Big names.
And they filed for Chapter 11 bankruptcy.
And GPC got caught holding the bag.
They certainly did. GPC took a hit of approximately $150 million. This was a mix of bad debt money, First Brands owed them that they will never see, and uncollected rebates.
Explain the rebate part for the listeners. Why would a supplier owe GPC money?
In retail, volume rebates are huge. It works like this. GPC buys 1 million oil filters from First Brands. First Brands says, if you buy 1 million, we will give you a 5% rebate at the end of the quarter.
Okay.
GPC books that 5% as profit before they even receive the cash. They account for it, assuming it's coming. But then First Brands goes bankrupt and says, sorry, we don't have the cash to pay you that rebate.
Ouch.
Suddenly that profit you booked, it vanishes. You have to write it off.
$150 million is a massive amount of vanishing profit. But is it just about the money?
No, it's about the shelf space. Management claimed in the call that they have no operational disruption for 2026 because they scrambled and found alternative suppliers.
But come on.
Think about the logistics of that. You have thousands of SKUs, oil filters, wipers, spark plugs that were coming from First Brands. Suddenly, the spigot turns off. You have to rush to other vendors, negotiate new prices, get that product into your distribution centers, and get it out to stores.
That sounds like a recipe for empty shelves.
It creates friction.
Yeah.
If I'm a Napa independent owner, a guy running a local shop, and I can't get Trico wipers because the corporate is dealing with bankruptcy, I'm angry.
You're going somewhere else.
I might call O'Reilly instead. Management says they handled it, but taking a $150 million hit suggests they didn't handle it before it became a crisis. It suggests a fragility in their supply chain visibility. They let themselves get too exposed to a counterparty that was clearly in trouble.
And then, just to ensure the misery was complete, there was the asbestos reserve.
The cherry on top of this sundae of despair.
Ah!
They added another $13 million to their asbestos reserve. GPC has been dealing with asbestos claims for decades. Legacy parts from the old days. But they noted that claims frequency and severity rose in Q4.
It really does feel like the big bath theory in action.
For those who don't speak accountant, the big bath is a strategy. If you know you're going to miss earnings anyway, you might as well miss by a mile.
Just get it all out.
You throw every piece of bad news, every write-down, every charge you can find into that one quarter. You flush all the toxicity out of the system so that the next quarter you start clean.
So they knew the pension charge was coming. They knew First Brands was collapsing. So they said, let's just dump it all here. Take the stock price hit, blame the messy quarter, and promise a clean start for 2026.
That is exactly what this looks like. The problem is, the market doesn't trust that the bath is over. The First Brands issue could have ripples. The asbestos claims could keep rising.
Right.
And that brings us to the actual operating performance. Because even if you strip out the pension and the bankruptcy and the asbestos, the underlying businesses are moving in opposite directions.
Let's break down the segments. We have the good child and the problem child. Let's start with the good child. Global industrial or Motion?
Motion is the crown jewel. Frankly, it's the reason many investors might want to stick around for this divorce. Sales were up about 4.6% in the quarter. Comparable sales, same-store sales, were up 3.4%.
To put that in perspective, what was the macro environment for industrial companies?
Terrible. The PMI, the Purchasing Managers Index, was below 50 for most of 2025.
So contraction.
A number below 50 means the manufacturing economy is contracting. So Motion's customers, factories, plants, mines were technically in a recession. And yet, Motion grew sales nearly 5%.
That is impressive relative strength. How are they bucking the trend?
Pricing power and digital execution. Their e-commerce penetration is now around 45%. They're becoming a digital-first industrial distributor. But more importantly, they have MR sticky power.
Okay, MRO, remind us.
Maintenance, repair, and operations.
Explain MRO economics.
Imagine you run a food processing plant. You have a conveyor belt that packages frozen peas. If a bearing on that belt breaks, your entire line stops.
The whole thing grinds to a halt.
You are losing thousands of dollars an hour. You don't care if the bearing costs $50 or $80. You care if Motion can get it to you right now. Motion has the inventory and the logistics to do that. That gives them incredible pricing power.
So they're selling uptime, not just parts.
They are selling uptime, exactly.
So Motion is resilient and
getting better. 2026 started with the PMI ticking back above 50. So the industrial economy is waking up just as Motion is hitting its stride. This confirms the thesis of the split. Motion is a high-quality asset that is currently being dragged down by the other side of the house.
Which brings us to the problem child. North America, Automotive, or Napa.
This is where the pain is. Sales were up about 2.4%, but that is misleading because profit margins compressed significantly. Segment EBITDA for North America was down.
What is going on with Napa? Is it that people aren't fixing their cars?
It's nuanced. The commercial side, the do-it-for-me side, where garages buy parts, is actually holding up okay. That grew about 3.5%.
Okay, that's not bad.
The problem is the retail side DIY, you and me buying wiper blades, is down about 4%.
Why is DIY dying?
Inflation and deferral. The low-end consumer is tapped out. Parts are expensive. Labor is expensive. People are just driving with the check engine light on.
I feel seen.
They're deferring maintenance until the car literally won't start.
But Napa has a specific structural issue too, right? The independent owners.
This is crucial. Unlike AutoZone, which owns all its stores, Napa is a mix.
Yeah.
A huge chunk of their network is owned by independent small business owners who just license the Napa brand.
Right.
And those independent owners are scared.
Management said sales to independent owners were flat to down.
Think of the independent owner. Their rent is up. Their utility bills are up. Their labor costs are up significantly. Interest rates on the loans they use to buy inventory are high. They are being squeezed.
So what do? They
destock. They stop buying inventory from GPC corporate. They run their shelves lean to save cash.
And that hurts GPC's revenue immediately.
It hurts revenue, but it also hurts the network effect. If the independent stores don't have the parts in stock, customers stop coming. It's a vicious cycle.
Right.
And on top of that, GPC itself is facing inflation. They mentioned high single-digit inflation in healthcare costs for their employees. Wages are up.
So you have rising costs, and your biggest customer base, the independent owners, is buying less. That is a recipe for margin compression.
Exactly. That is why the North American auto margin dropped 70 basis points. They're getting squeezed from both sides.
Now, if North America is the problem child, Europe is the anchor.
Europe is the heavy anchor dragging the ship down. Sales were down 2% in local currency. Comps were down 3%.
Yeah.
The geography mix is just brutal. The UK, France, and Germany are all weak.
And management didn't exactly paint a rosy picture for the future there.
No. They explicitly said they do not expect Europe to improve in Q1 2026.
Yeah.
They are assuming it stays bad. This is a big reason why the guidance was so prudent. They are baking in a recessionary environment in Europe for at least the first half of the year.
This reinforces the split argument, doesn't it? If I'm an investor in Motion, why should my stock price be penalized because French consumers aren't buying brake pads?
That is the core argument. Europe is dragging down the whole ship. By cutting the cord, you isolate that risk to the auto company. Of course, if you end up holding the auto company stock, you're stuck with it.
Yeah.
Europe is GPC Auto's problem now, not Motion's.
Let's talk about that investor context and the outlook for FY26. We mentioned the guidance was weak. Sales growth of 3 to 5%. Adjusted EPS of $7.50 to $8. Let's decode that.
Let's look at the components.
Yes.
Sales growth of 3 to 5%. Management said they expect the market volume to be flat.
Flat.
So they aren't selling more widgets.
Yeah.
The 3 to 5% is coming entirely from pricing inflation and maybe a little bit of acquisition benefit.
So it's not organic growth. It's just charging more for the same stuff.
Correct. That is not a growth story. That is a survival story.
And margins.
They expect gross margin to expand slightly, which is good. That shows their pricing initiatives are working. But SG and A selling, general and administrative expenses is going to deleverage.
Meaning?
That means their overhead costs are growing faster than their sales. That's the inflation in wages and healthcare biting them.
Is there a sandbagging scenario here? Are they setting the bar so low they can step over it?
I think so. Look, they just missed earnings by 15%. They have zero credibility right now. The last thing they want to do is guide high and miss again.
Yeah, that would be a disaster.
So they are assuming Europe stays terrible. They are assuming the independent owners don't bounce back. They are assuming the supply chain remains a mess.
So if the U.S. consumer wakes up, or if the industrial recovery accelerates,
They could beat these numbers easily. This is a floor guidance. They want to be able to beat and raise later in the year to regain trust. It's a classic turnaround tactic. Reset the baseline so low that any pulse of life looks like a victory.
amidst all this carnage, we have to mention the dividend. They are a dividend aristocrat. Did they cut it?
They did not. In fact, they raised it. The board approved a 3.2% increase. This is their 70th consecutive year of dividend increases.
70th. That is an incredible streak.
It is. And with the stock down 14% today, the yield just got a lot more attractive.
It certainly did.
If you are an income investor, you are looking at this drop and licking your chops. The yield pushed up significantly. And importantly, both new companies, auto and industrial, are targeting investment-grade credit ratings and plan to pay dividends. So the income story is still intact, even if the growth story is broken for now.
But we circle back to the timeline risk. We talked about 2027 being far away. What are the operational risks in 2026 while they are preparing for the split?
The biggest risk is distraction. Management is going to be spending a huge amount of time on lawyers, bankers, and organizational charts to execute this split. When leadership is focused on a split, they sometimes take their eye off the ball operationally. And in a market this tough, with inflation, bankruptcy at suppliers, and weak demand, you can't afford to take your eye off the ball.
So to summarize where we are before we get to the trade, GPC had a disaster quarter. They are splitting the company to unlock value, but that value is a year away. In the meantime, they are dealing with a messy supply chain, a recession in Europe, and angry independent store owners.
That is a fair summary. It's a jam tomorrow story. You have to eat the stale bread today to get the jam tomorrow.
Okay. I don't like stale bread, but I do like making money on market overreactions. This leads us perfectly into our final segment. The segment where we stop being analysts and start being, well, creative opportunists.
Let's do it.
This is not financial advice.
Disclaimer time. We are just two voices in your headphones. We are not your financial advisors.
Yeah.
Do not trade based on what we say. We are just brainstorming. Don't sue us. Seriously, this next part is speculative.
Okay, lay it on me. The market hates uncertainty. GPC is a lame duck. The stock is down 15% to 125. What is the play?
I call this trade the dirty divorce arb.
The dirty divorce arb. I like it. How does it work?
The thesis is simple. The market is overreacting to the kitchen sink quarter and ignoring the quality of the industrial business. Motion is a compounder. It's a high-quality business hidden inside a messy retail auto shell.
Okay.
Right now at $125 a share, you are effectively buying the industrial business at a discount and getting the auto business for free.
Okay, so step one is buy GPC.
Step 1, buy GPC aggressively at these lows. You step in while everyone else is peaking the stock. But, and this is the key, you don't want the auto exposure. You hate the auto exposure. You think Napa is going to keep struggling.
So how do I get rid of it?
You hedge. You create a synthetic short against the auto side. You short a basket of pure play auto retailers. You short AutoZone. You short O'Reilly. Or, if you want to be really specific, you short a European consumer discretionary ETF to hedge that European exposure.
Walk me through the math. I'm long GPC, which is auto plus industrial.
Right.
And I'm short pure auto.
Exactly. So mathematically, you have isolated the motion industrial exposure. If the whole auto sector tanks because consumers stop driving, your short on AutoZone makes money, offsetting the loss on GPC's auto segment.
Okay, you're market neutral on auto.
You're market neutral on auto. So what drives the profit?
The re-rating.
The re-rating of the industrial business.
Yeah.
You are betting that when the split happens in 2027, the industrial stock will re-rate. Look at Grainger. Look at Fastenal. Those stocks trade at 20, 25 times earnings. GPC is trading at like, what, 15 times?
Less now.
Less now.
Yeah.
When motion becomes its own ticker, the algorithms will suddenly see it as an industrial distributor and not an auto parts store. The multiple will expand.
So it's a valuation arbitrage. You are buying $1 for 70 cents and waiting for the market to realize it's $1.
It's a patience arbitrage. You hold the stock for 12 months, you collect that fat dividend, which is now yielding probably close to 3.5 or 4% after the drop. You wait for the S4 filing.
And for the cowboys out there, the ones who want leverage.
If you want to go full hedge fund cowboy, you don't buy the stock, you buy deep out of the money calls for January 2027. This is the LEAP PS strategy.
LEAP long-term equity anticipation securities.
Right. You buy calls with a strike price back at the old highs, say $145 or $150. Nobody wants them right now because the stock just crashed. They are dirt cheap.
So you buy them cheap.
The implied volatility might be high today, so maybe you wait a week for it to settle. But the moment the S4 filing drops and the analysts start publishing their sum of the parts models, the stock is going to rip to close that valuation gap. You could see a 30% move in the stock price, which would be a 500% move in the options.
That is spicy and highly dangerous if the gain falls apart or is delayed.
That's why it's not financial advice. But look, the market is emotional. Today, it was emotional about the earnings miss. In a year, it will be emotional about the new, exciting industrial pure play. You're just betting on the mood swing.
The dirty divorce arb. I love it. It takes guts to buy a falling knife, but the logic holds up if you believe in the industrial asset.
It's messy, but profitable, just like a real divorce.
Too soon.
Maybe.
All right, let's wrap this up. Recap for the listeners.
Genuine parts company. Ugly earnings. Huge one-time charges pension. First Brands, asbestos. But a light at the end of the tunnel with the 2027 split into auto and industrial.
The market punished the past, the earnings miss, rather than pricing in the future. The split. The stock got hammered, down almost 15%.
The question you have to ask yourself is this a value trap or is this the buying opportunity of the decade? The answer lies in whether you believe Napa can stop the bleeding before the divorce papers are signed. If Napa stabilizes, this stock is a scream buy. If Napa gets worse, that 2027 split might not be enough to save you.
A fascinating setup for a boring old parts company. That is all we have for this deep dive. As always, thank you for listening.
And remember, in a market this volatile, keep your eyes on the road.
Keep watching the tickers. We'll see you next time.